Welcome to our series of recap videos and to our introduction to accounting course. Welcome back, ladies and gentlemen. Let's look at how debt financing also impacts the three statements. So over here, we're going to assume we are taking on debt, either fixed or variable, and we are going to pay interest, and we'll see how it works out based on the assumptions we have outlined here from 1 to 6. So assuming we are taking a variable debt, so we issue variable debt of 3,000. Then again, you will see that we have taken on debt, so it means we have gone for a loan or a variable debt of 3,000. So it's a cash inflow, so we have gotten some money. And when we come here, you see that now our cash balance is 3,000, feeding back to the cash here, 3,000. And now because we have taken on a loan, our variable rate long-term debt has also increased by 3,000. If we pay off during the year, we pay off or we redeem 600 of the loan. What it means is that our loan, which was 3,000, we have made some payment of it of 600. We have actually paid it off from cash, so the cash element has gone down by 600. So the cash balance here will be 2,400, which will feed back into the cash and cash equivalents we have here in the cash balance sheet. And then because we have paid off 600 of the loan, our outstanding obligation to the variable term term debt will be 2,400. But if we pay interest, so let's assume we pay interest of 15% on the outstanding balance. Once we have 2,400 outstanding balance, the interest component is what will be charged to the income statement. So just like the long-term assets, if we don't depreciate, no impact on the income statement. Also for debt, if we don't charge interest, it has no impact on the income statement. So we have a balance of 2,400 and we pay interest of 15% of that, giving us 360, and that becomes a cost, actually not a notional charge, but that becomes a real cost that we have to pay to our debt financiers. So that becomes that. But then our balance will still be 2,400 we have to settle, and that's showing in our liability here. And once we have received 3,000, paid off 600, we have cash in our hands of 2,400, and then also we have paid 360 out as interest expense. So our cash element of the 2,400 has further been reduced by this 360 because we have paid interest element on it. So we have a cash balance of 2040, and that feeds here as 2040, and the balance of the total asset being 2040. When we come down to the liability and equity section, we have the balance of the variable term debt being 2,400, and then we have retained earnings of negative 360, and that balances out 2040 in our balance sheet. Same applies to fixed term debt. So when we take on a fixed term debt of 2,500, until we pay any interest thereon, it still has no impact on the income statement. So we take on fixed term debt 2,500, means our cash has increased by 2,500, and then we redeem some part during the year. We redeem 500 during the year, so it means it has reduced from 2,500 to 2,000, and with the balance also showing in the balance sheet here. And if we decide to pay interest on the outstanding balance of the 2,000, if we are paying 10% on the outstanding balance of the 2,000, means we are paying 200 cedis, which one adds to, so let me just put this one off so you can see how much. So that is 200, which will then add to the original 360, making our interest expense being 560. That is 360 from variable term debt and 200 from the fixed term debt. So that will be adjusted here. That will be our net income. And once we have received this much and paid our sum, the net balance gives us 4,400, and we take out the 5,560 interest element we have paid. We have a cash of 3840 feeding into our cash, and our total asset being 3840. When you come down to the liabilities and equity, we are making a income surplus or retained earnings of negative 560 because we have only paid an expense of 560. We haven't had any cash, just for purpose of illustration. And then our balance sheet balances with 3840, also the same as the balance we have at the total asset. So that is how the debt element comes in. So you should know that once you issue or you repay, the impacts are all within the cash flow and the balance in the balance sheet. The only impact we'll have on the income statement will be when we pay interest on it. Thank you.